$2.13 an hour. That's Marcus's official wage out of Chicago, the federal minimum for tipped workers. Chicago, the city with the highest combined state plus city cigarette tax in the country, $7.16 per pack. But this isn't about cigarettes. This is about the fact that this guy's investment portfolio is bigger than the average MBA graduate's. And here's the strange part. Marcus never picked a single stock. Not one. Never opened a chart. Doesn't subscribe to Goldman Sachs research. Never listened to Jim Cramer. He spends 30 minutes a month on investing. 30. Less than the average American spends standing in line at Starbucks. And yet his results are better than 9 out of 10 Wall Street professionals. Not a metaphor, a statistic. We'll get to it. Over the next 18 minutes, 3 things that will flip your understanding of money. First, why where you work matters more than what you do. Second, a 5-line savings formula that permanently kills the save or live conflict. And third, why more than 94% of Wall Street professionals lose to a strategy available to anyone with a phone and $50. Quick note, Marcus is a composite character. The name is changed. Details are blended from several real stories. But every number, every study, every calculation is real. Sources are in the description. Let's go. Marcus grew up on the south side of Chicago, a neighborhood where storefronts are boarded up with plywood, and the only financial advice from the neighbors is, stay away from credit cards. His father left when the boy was 6. His mother worked 2 jobs, cashier at Walgreens during the day, janitor in an office building on Michigan Avenue at night. The money covered rent. Sometimes it didn't. At 12, Marcus bought his first laptop, a used Dell for $85. The money came from mowing lawns and washing cars over 2 summers. At 14, he got a job as a busboy at Denny's on Halsted Street. Pay that same $2.13 plus tips. An 8-hour Saturday shift brought in $65 to $80. Not a lot. But for a teenager from the South Side, the first taste of control over his own life. Marcus is now 28. Between that Denny's and today, 14 years. Here's what happened in that time. But the most striking thing isn't the amount he saved. It's what happened when he tried to beat the market. He lost $4,200 in 3 months. Remember that number. It'll come back around. When Marcus turned 19, he quit Denny's. Not for a dream job. He did something simpler and at the same time far more radical. He walked into a steakhouse in River North, a neighborhood where parking costs more than his monthly rent. Gibson's Bar and Steakhouse on Rush Street. Opened the door, walked up to the hostess. Hi, I want to work here. Put me in any position. Rejected. He walked out. 2 blocks, RPM Italian. Same pitch. Same answer. 3rd restaurant. 4th. 5th, 6th, 7th Maple and Ash on the Gold Coast. The manager looked him over. Experience. Marcus exhaled. 4 years at Denny's. I can start today. They hired him as a busboy. Not once in his life has Marcus used Indeed, LinkedIn, or Monster. Every job through the front door. In person. On foot. Now the math that breaks your brain. Denny's. Average check. $14 per person. Tips 15 to 18%. A table of 4 brought in $8 to $10. Per shift, 10 to 12 tables. Total, $80 to $120 per evening. Maple and Ash. Average check, $135 per person. A table of 4, $540 to $700. Tips 20 to 22% because in fine dining people tip more. 1 table $108 to $154. Per evening 6 to 8 tables. Total $650 to $900 per shift. Same person. Same hands. Same phrase. Ready to order? Income difference 5 to 7 times. Not because Marcus suddenly got smarter. Because he changed his environment. The floor manager at that same Maple and Ash made $65,000 a year. Marcus as a server, $95,000 to $110,000. The manager, stable salary, fixed schedule, more responsibility, health insurance. The server, 0 guarantees, dependent on tips, Weekends and holidays on your feet. No sick days. Risk equals return. A law that works not just in the stock market, but in your career. Hold that thought. In a minute, a mistake worth $4,200 that paradoxically made Marcus richer. But first, a detail without which the whole structure falls apart. Marcus grew up in poverty. It left a scar. The fear of going back to where he clawed his way out of. Psychologists call it trauma-driven discipline. Discipline born from trauma. Doesn't sound pretty. Works like clockwork. Every unspent dollar. A small brick in the wall between Marcus and the South Side. One catch. Fear is powerful fuel, but dirty fuel. Sooner or later, it burns out. Marcus needed a system that could run without adrenaline. He opened the Notes app on his phone. Wrote 5 lines. 5 lines that replaced a financial advisor, a budgeting app, and 3 Dave Ramsey books. Word for word. Income under $3,000 a month. Save 5%. 3 to 4,000, save 10%. 4 to 6,000, save 20%. Everything above 6,000, 50% of the surplus goes to investments. Everything above 8,000, 70% of the surplus goes to investments. That's it. No envelopes, no spreadsheets with 30 expense categories, no tracking every burger. End of the month, check total income, apply the rule, transfer the difference to the brokerage account. The beauty is in the mechanics. When Marcus earned little, the system didn't choke him. 5% of $2,500, that's $125. You can live. When he earned a lot, the system accelerated. $10,000 in December, the week before Christmas, generous tips. A significant chunk of the surplus went to investments. His spending grew too. He wasn't living on rice and beans. He bought decent sneakers, flew on vacation, took his girlfriend to a restaurant, just not the one where he worked. Notice what happened? The save or live conflict resolved. Not through willpower, not through a motivational video, through architecture. March 2020. The pandemic. Restaurants shut down. Marcus is sitting at home. $22,000 in a brokerage account, $1,200 in unemployment benefits, and a freshly downloaded Robinhood app. Everyone around him was making money. Reddit, Twitter, YouTube, every other post about some guy who bought Tesla at 400 and sold at 900. GameStop, MC, Dogecoin. It felt like not playing individual stocks meant missing the only train. Marcus bought Tesla, bought Palantir, bought a biotech startup with a name he couldn't pronounce. 3 months later, minus $4,200. $4,200. A week of good tips up in smoke. It hit him in the gut. And then he stumbled on a number. 94.1%. According to the Spiva scorecard from S&P Dow Jones Indices, a division of the company that created the S&P 500 index itself, over the 20-year period from 2005 through 2024, 94.1% of all active funds in the U.S. market underperformed the S&P 1500 composite index. Not written by a blogger, not by a guru, by the organization that maintains these indices. Stop. Read that again. People with Wharton and Harvard degrees, with Bloomberg terminals costing $30,000 a year, with teams of analysts who don't sleep at night, with access to information you don't have and never will. On a risk-adjusted basis, the results are even worse. 97.3% of funds lagged the benchmark. 97.3%. Less than half, just 48.5%, of active funds even survived to the end of those 20 years. The rest closed or merged with others, burying their dismal track records. Warren Buffett, the man they call the greatest investor in history, in 2007 placed a $1 million bet that an S&P 500 index fund would beat a portfolio of 5 hedge funds over 10 years. His opponent, Ted Seeds from Protege Partners, accepted the wager. 2017. The finish line. The index, 125.8% total return. The best of the 5 hedge funds, 87.7%. The worst, 2.8%. 2.8% over 10 years. Buffett won. He donated the $1 million to charity. But the lesson was worth more. If the greatest investor on the planet tells you not to try to beat the market, maybe it's worth listening. Marcus deleted Robinhood, opened an account at Vanguard, set up automatic transfers. Every month, a fixed amount into 3 funds. VOO, the S&P 500 index. Expense ratio 0.03% per year. 3 cents for every $100. BND bonds. A stabilizer.
Yao, gold.
Insurance against chaos. Time spent managing it. 1 check per month. Half an hour. Sometimes 15 minutes. The paradox that's hard to get used to. The less Marcus did with his portfolio, the faster it grew. This isn't Zen Buddhism. It's statistics. Meanwhile, Marcus discovered money where nobody looks for it. He called it the inattention tax. Starbucks. Every morning. A grande caramel macchiato. $6.75 after tax in Chicago. Every day. 365 days. $2,464 a year. Over 10 years. Adjusted for inflation, roughly $29,000. Now factor in investing. If instead of coffee, Marcus had sent $6.75 daily into VOO, at the S&P 500's average annual return of 10.59%. Data from the Stern School of Business at New York University going back to 1957, when the index expanded to 500 stocks, in 20 years that would have grown to roughly $155,000. $155,000. From morning coffee. Marcus didn't quit drinking coffee. He bought a $40 coffee maker and Kirkland beans from Costco at $14.99 a bag. The difference into the index. Even more vivid, cigarettes. The average price of a pack of Marlboros in Chicago, $16. Thanks to that combined state plus city tax of $7.16, the highest in the country. A pack a day, $5,840 a year. Marcus doesn't smoke. But he calculated the smoker's portfolio. If you invested the cost of a daily pack over 25 years at 10.5% annually, you'd end up with roughly $660,000. More than $500,000. Gone up in smoke. Literally. January 2022. The S&P 500 started sliding. By October, down 25%. Marcus's portfolio dropped from $58,000 to $43,500. Red numbers every day. Every podcast. Recession is inevitable. Every coworker at the restaurant. Told you. Stocks are a casino. His mother called. Take your money out before it's too late. His hands shook when he opened the Vanguard app. According to Dalbar Incorporated, a firm that has tracked retail investor behavior since 1994, the average individual investor consistently earns 3 to 4 percentage points less per year than the market overall. Not because of bad stock picks. Because of panic. They sell at the bottom, buy at the top. Emotions eat returns more reliably than any fees. Marcus didn't sell a single share. In fact, he increased his monthly contribution. One thought outweighed the panic. If the economy is going to be bigger in 15 years than it is today, a crash means one thing. A sale. Discounts. Black Friday on the stock market. Fast forward. The S&P 500 gained 23% in 2024 after 24% in 2023. In 2 years, the index rose 53%, one of the strongest 2-year stretches since the late 90s. And in 2025, the S&P 500 added another 17%. Marcus, who didn't sell in October 2022, rode that rally fully invested. Those who sold watched from the sidelines. The numbers that made it worth sticking around to this point. $500 a month. An S&P 500 index fund. Average historical return, 10.59% annually. Data from the Stern School of Business at New York University, since 1957. Time horizon, 25 years. Result, roughly $620,000. Of that, $150,000 is your money. The other $470,000, compound interest. Money that your money earned. And then money earned by the money your money earned. Sounds like a tongue twister. Works like an avalanche. $1,000 a month? About $1,240,000 over 25 years. And if your income grows and your monthly contribution increases by just 5% a year, roughly $2.5 million by the time you turn 52. Anyone can check these numbers. The compound interest calculator on investor.gov, the official website of the Securities and Exchange Commission. Compound interest is a snowball rolling down a mountain. The first 100 meters, a clump the size of a fist. You invest for 4 years, the portfolio is up $1,200 and you want to quit. Pointless. And then the last 100 meters, an avalanche. But only those who weren't knocked off at the first turn ever reach the avalanche. Marcus is 28. His portfolio $215,000. Of that, 3 consecutive years of market growth did the heavy lifting. 9 years of consistent contributions, 1 bear market, 0 attempts to beat the index after 2020. He opened the calculator, entered his parameters, looked at the number next to age 45. For the first time in a very long time, he smiled. Something Marcus kept quiet about for a while, because it breaks his regular guy image. In 2023, he started a TikTok. Behind-the-scenes restaurant life plus personal finance without the jargon. First video, how to calculate a tip so you don't shortchange yourself or your server. 2.4 million views. 8 months, 340,000 followers. Sponsored posts, $2,000 to $4,000 per video. For videos a month. Do the math. The media presence became a multiplier. Not a replacement for his main income. A lever that tripled his total cash flow. Here's where a contradiction surfaces. One, Marcus acknowledges honestly. He calls himself an ordinary person. But an ordinary person doesn't knock on 7 restaurant doors in a single day. Doesn't write a savings formula in his phone's notes app. Doesn't launch a TikTok with a 3-month content plan. Doesn't spend evenings reading Spiver reports instead of scrolling Reddit. Here's the truth nobody likes to hear. 99 out of 100 people won't replicate his path. Not because the path is hard, but because it demands action at the exact moment when it's easier to do nothing. That's not laziness. That's inertia. It's the real enemy, not a lack of knowledge. You just got the knowledge. The question is what you'll do with it. Marcus laid out 2 routes for 2 types of people. The path of action for those who need adrenaline. Risk, multiplied by accountability for consequences. Hypothesis, action, analysis, repeat. Change restaurants. Start a blog. Walk into your boss's office with a folder in hand. Here's what I've done, here's how much I brought in. Let's talk about compensation. The path of patience for those who need peace. $500 a month. An index fund. Don't touch it for 20 years. Don't check it more than once a quarter. Don't listen to anyone promising 30% annual returns. Seriously, no one. Both routes lead to the same place. The place where your money works harder for you than you work for money. $2.13 an hour. A number that hasn't changed in 35 years. Congress said it when Marcus didn't even exist yet. Here's what Congress didn't anticipate. That a kid from the South Side would take those $2.13 as a starting point, break the architecture of income, write 5 lines in his phone's notes app, and outperform 94% of Wall Street. Not because he's a genius, but because he asked the right question. Not which stock should I buy, but where can I find more money to invest? A question for you. One habit, one expense, one decision in your life that, if reconsidered, changes all the math. What is it? Drop it in the comments. Like if you made it this far. Subscribe if you want the next chapter. Hit the bell so it doesn't get lost in your feed.